All right. Hello, everybody. Good morning. Happy Thursday to you. I hope you're having a great day. Pretty sure it's morning for most of us that are here today. I want to welcome you to our workshop today, the S Corporation Red Flag. We're going to be going over some great information today. We do have a Q&A box available for you. If you could, just to make sure that my technology is working, if you could pop a loud and clear, or yes, I can hear you in that Q&A box, just to make sure that I've got everything set up right, and make sure you can see this screen okay. Great, excellent. Thank you, Chris. Thanks, Rob. All right. Rita, thank you. Looks like we're good to go. So we'll go ahead and get rolling without any further ado. Today's session is being recorded, and thank you for registering. There might be some folks that did register that can't attend today, so we will get them the recording as well as get you a copy of it after the session today. You can pop any questions into the Q&A box either during or at the end of the presentation. Probably will not be answering any as we move forward through the presentation until we get to the end. There's a good chance that a question that comes up during the presentation will get answered during the presentation. We just want to make sure that we cover that. So if you are here for the potential red flag of S corporation entities and what IRS is starting to put on radar, you are in the right spot. And I do have a quote up on the screen by William Rehnquist, the U.S. Supreme Court Justice, that we try to keep in mind when we're doing tax planning and corporate entity planning for our clients. There's nothing wrong with a strategy to avoid the payment of taxes. The Internal Revenue Code doesn't prevent that. Now, there's a big difference between tax avoidance and tax evasion. I'm sure you've all heard the joke that typically the difference is about 20 years. Let's go ahead and move on. We've got some housekeeping here, legal stuff. So this is an educational webinar workshop. This is not one-on-one coaching or advisory advice. If you do want a one-on-one session with us, reach out to us. I'll have information at the end of the presentation for that. Unfortunately, one thing I can guarantee after 30 years in this business, I can guarantee that Congress will always change the tax laws, sometimes multiple times a year. So the information in today's workshop is as error-free and current as I can make it, but let's face it, Congress and the IRS keep changing the rules, and it could change as early as next month. We just don't know, and then we have to be able to pivot. So while I believe everything is current and up to date, I cannot guarantee that it will be for the foreseeable future. We also have some copyrighted materials in here. We do have copyrights and licenses for the various materials. Real quickly, some of you know me, some of you may not. My name is Bill Bourbonnais. I'm co-founder of Bourbonnais Tax Associates in Raleigh with my wife, Laura. I started my first tax practice back in 1993 in San Diego, California. So I've been around the block a little bit. Love tax. I got hooked on it during a short tax course in San Diego, and really, aside from a few pivots here and there, haven't looked back. I hold undergraduate and graduate degrees in business finance, and I received my enrolled agent license in 1997. Enrolled agents are the only federally licensed practitioners with unlimited rights to represent taxpayers at all levels at IRS. The only other professionals that have that unlimited right are certified public accountants and attorneys. Both of those licenses are granted by state boards of accountancy and state bar. The enrolled agent is a designation issued by the United States Treasury and is actually about 3 years older than the CPA license. The EA license came about with the Horse Act of 1861 when the government felt that there were a lot of abusive requests for reimbursement for horses that were conscripted into the Civil War. So they created the enrolled agent's license to represent taxpayers to make sure everything was compliant. I'm the best-selling author of You Can Deduct That. That's available on Amazon. That's back from spring of 2016. That was a fun project, and an active member of the Tax Master Network, National Society of Accountants, not the NSA, National Security Agency. National Association of Enrolled Agents, and American Society of Tax Problem Solvers. So what we're going to do today is we're going to take the view of this particular topic from the 30,000 foot level. Unfortunately, in the span of about 45 minutes to an hour, I can't make you a tax expert. Like I mentioned, I've been doing this about 3 decades, and I am constantly learning new stuff. So there's always something new to learn. Congress always throws us new curves, and we just have to keep keeping on and try to keep up with everything. So I don't think anybody will ever become a perfect expert in taxes, but we'll give you a pretty good overview today so that you can work with us or work with your tax professional on the right path for this. What we'll cover today is an introduction and back to the basics. I do want to touch on Entities 101. Some of this might be just a quick review for you. Some of you may have never realized that there's so many choices out there for business and taxes. We'll take a look at the S Corporation overview, and then we'll get into the red flag. And of course, the question you're all going to have is, well, why do I care? And I've got some good information on that. We've got some other considerations that play into the S Corporation structure that you need to take into account. And then we'll wrap up with what's the solution and some Q&A time. So something to consider when you're planning out taxes, when you're planning out your business, when you're planning out really anything in life, even your financial security and your retirement, if the only tool you have is a hammer, everything starts to look like a nail. And that's a problem, because if you have your own workshop, if you've worked in any kind of woodworking or plumbing or any kind of hobby or profession like that, you realize there's a lot more tools than just a hammer. But if all you have is a hammer, you're going to be cutting wood with a hammer, which is not the appropriate tool. You're going to be hammering nails, which is the appropriate tool. You'll be trying to put screws in with a hammer, which isn't the appropriate tool. So again, if the only tool you have is a hammer, everything looks like a nail. Similarly, if the only tool you have for your business entity is the advice of friends, family, and other associates who may not understand the underlying structure of what businesses are, a lot of times you've got a well-meaning uncle or friend that says you need to be an S corporation or an LLC when you go into business. Well, corporate structures, business entity structures are a tool. And if the only thing you have is bits and pieces of advice or Dr. Google, then you may not be using the right tool for what your goals and objectives are. It's important to use the right tool. And we'll be focusing a little bit on S corporations today, but I do want to make sure that you understand what the differences are and how this plays into the S corporation structure and why IRS is targeting S corporations for this particular red flag. So if we look at back to the basics entities here, we've got 4 types of business entities that are recognized under the Internal Revenue Code that you can start up. The first one is sole proprietorship. That's really easy to set up. You just hang out a shingle, decide you're going into business, and you're there. You're taxed really at the least advantageous rate, but you are your business. And the downfall there is because you're a sole proprietorship and you are the business, you are personally liable for everything that happens in that business. There's no corporate veil that can protect your personal assets. There's really no benefit on the tax side. It's a great way to start up, but it is a proper tool used for a certain thing. If you've got a side hustle, a part-time gig, that might be a perfect entity structure to start off as, but eventually as you grow, you may want to look at other ones. And that's why when we do planning, we implement Stephen Covey's second habit from the 7 Habits of Highly Effective People, and that's to begin with the end in mind. We may start you off with a certain structure when we do your planning, but we want it to be flexible enough to move into other structures. Another business entity structure is a partnership. That's similar to a sole proprietorship, but in this case, we've got 2 or more people involved. This could even be a husband and wife. And a lot of times, unfortunately, we've got over-the-counter filings you can do with the state to set up your LLC. Husband-wife LLC goes in, files for an LLC. They both list themselves as members. They get their EIN listing them both as members. They don't realize that under the tax law, they're a partnership. And they thought their personal extension was going to help that, and they were going to file everything on their 1040. Well, now IRS is assessing $200 a month per K1 for a late filing penalty for that partnership return. So you have to be aware of the tool you're using and make sure that you're compliant with that tool. The next opportunity under business entities is the S corporation. That's what we'll be looking at here. S corporation is set up through a filing with your state corporations division or secretary of state, either as a corporation or we'll see in a little bit as an LLC. And then there's an election made that's filed with the IRS and sometimes states that create a tax benefit, a tax advantage for the S corporation. And then our final tax entity structure is the C corporation. That's what you hear a lot about with double taxation. Every publicly traded corporation is a C corporation, and it's a great way to do other things. Again, you have to have the right tool to reach your goals in anything. C corporations are great for if you want to drive benefits or split income. Stepping back to the S corporation, that's a great direction if you're earning income and you want to tax maximize the income that you're earning. Partnerships are good for holding assets, and I'll give you a quick synopsis here. Typically, if any of you are looking at investing in real estate, the worst corporate structure to set up your rental real estate in is a C corporation, and we'll talk about that briefly a little bit later. And then, of course, we've got sole proprietorship. That's the most heavily taxed opportunity or option there. Now let's take a look here at incentives for abuse. Well, when you start off a business as a sole proprietorship, everything's taxed to you. You're paying income tax and you're paying what's called self-employment tax, which is the self-employed version of the Social Security and Medicare that are taken out of your W-2. You're paying both halves of that. When you're a W-2 employee, the employer is paying one half of the Social Security and Medicare, and you are having half of it withheld from your check every week or every other week. In the case of a sole proprietorship, any net income you earn is subject to the employer and the employee side because you are both employer and employee. And that's 15.3% on top of whatever your tax rate is. Incentives for abuse, from the perspective that we're looking at today, not many, but of course, people always try to write off personal expenses through their business. And that would be an abusive situation there. Partnership, similar situation. In this case, the taxation is very similar to a sole proprietorship, but now you've got two or more people. Each partner is going to get a K-1. Their net income on that K-1 is also going to be subject to income tax and also subject to 15.3% self-employment tax. Again, similar situation for red flag, opportunities for abuse here, or incentives for abuse here. We're not looking at anything really beyond tax and payroll taxes here, but we're looking at things that could trip you up under an IRS compensation audit. S corporation, here's the incentive for abuse. Here's the red flag, and this is what IRS is looking at. This is what we'll be talking about during most of the presentation today. There's an incentive with an S corporation because of how it's structured to take an artificially low salary that's subject to payroll taxes, and then the inappropriate distributions are taxed at just your income tax rate, not subject to payroll taxes. So there's an incentive for S corporation owners to either reduce, or in some cases, some S corporation owners don't even take a salary, which is a bigger problem than taking too low of a salary sometimes. We'll take a look at that. But that's an incentive to try to manipulate the system, try to game the system to avoid paying payroll taxes or self-employment taxes. And it will trip you up. It will get you in a lot of trouble if you head that direction. With a C corporation, and I mentioned this to some people that had asked about what we might talk about here, and reasonable compensation that we'll talk about comes into play with C corporations as well. And the way that comes into play is there's a flip on the incentive for abuse here on the red flag. There's an incentive with C corporations to take an artificially high salary that would be subject just to the employer and employee portions of the Medicare tax. Once you reach the Social Security wage base, which for 2022 is $147,000, the only tax, payroll tax remaining is the Medicare, 1.45 employer, 1.45% employee, 2.9% combined, which is substantially lower than the double taxation you would get by having the corporation pay its 21% income tax rate on the profits, and then you taking them out as a qualified dividend at 20%. for a combined rate of 41%. Big stretch between 2.9 and 41. And that's where the IRS will look at compensation that is too high in a C corporation. But let's take a look at this. What's missing? We covered sole proprietorships, we covered partnerships, we covered S corporations, and we covered C corporations. What's missing from that equation? Well, we've got limited liability companies, right? And what happens when we bring on a new client? They'll say, well, we're an LLC, but I need more information than that. Limited liability companies, the IRS doesn't recognize. They're really the chameleons of the tax world. LLCs are a construct of state law. So there is nothing in the Internal Revenue Code that says the tax rate for a limited liability company will be this. What you have is a situation where the IRS calls you a disregarded entity if you have an LLC. If you're a single member LLC, just one owner, one member, your default tax structure is a sole proprietorship. So if you don't make any other elections, advise the IRS how you want to be taxed. You will be taxed as a sole proprietorship if you're a single member LLC. If you're a multi-member LLC, 2 or more members, you'll be taxed as a partnership as the default structure. So again, you haven't made any elections, haven't decided what you want to be when you grow up. The default structure is a partnership taxation rate. The chameleon part of an LLC that's really cool is you can elect for your LLC to be taxed as an S corporation, or you can elect for your LLC to be taxed as a C corporation. So as you move up through the structures and the growth of your business with proper planning, remember Stephen Covey's habit number 2, begin with the end in mind. Set up your company the way you think it's going to be in 5 years so that you can make that transition smoothly. If you're a sole proprietorship, you can't make an S election or C election as a sole proprietorship. If you're a single member LLC taxed as a sole proprietorship, when it's appropriate, you can make that election for your single member LLC to be taxed as a S corporation or C corporation. Same thing with the partnership. If you're set up as a partnership, you would have to merge out to an LLC or corporation, then make the election. Or if you're already set up as an LLC, then when the timing is right and it's appropriate and it works for your plan and your business operations, then you make the election to one of the other structures. So I love the chameleon. It's a great tool, but again, going back to the hammer, it is a tool and has to be used the right way at the right time. So we're kind of going back to the chart here real quickly on business entities. So each one of these, as I mentioned, can be set up as an LLC, sole proprietor, single member LLC, partnership, multi-member LLC. S corporation, single member or multi-member LLC can make an S election. C corporation, yes, single member or multi-member LLC can make an election to be taxed as a C corporation. So using the proper tool at the proper time is important. Now let's look at that incentive for abuse real quickly. This is a kind of an assumptive model here. I'm assuming we've got a business owner that's in a 25% bracket and has set up a business, and they've got gross sales of $500,000 and overall expenses of $400,000. And in some cases, they decide to take a salary of $40,000. Sole proprietorships do not pay a salary to the owners. You're taxed on the full amount of net profit. You don't set up payroll for yourself. You're taxed on the profit of the business. So in this case, you'd have tax on your net income of $100,000 of $25,000. You'd pay $15,300 of self-employment tax. And this is a very simplified example, but your total taxes would be roughly $40,000 on that net income from your sole proprietorship. Partnership, again, the same taxation for the most part. We've got the same income, we've got the same expenses, we've got the same 25% bracket for the partners, we've got the same self-employment tax. In this case, $40,300 would probably be the aggregate taxes, and that's going to depend on the ownership percentages of the partners or how they do a revenue split and profit split based on their partnership agreement or operating agreement. The S corporation, here we've got a guy or a gal that has the same kind of business structure, but they're taking an officer salary of $40,000. And here's where that incentive for the S corporation starts coming into play. We've got a $40,000 salary, and that leaves $60,000 pass-through income. The tax on the net income at 25% is about 15. The tax on the salary is 16. There's no self-employment tax and there's no corporate or entity tax. So right here, we're saving about $9,000 just by converting that business to an S corporation. Now, is that $40,000 salary reasonable? That's the question that we need to look at today. The next column over is assuming that somebody's really rigging the game and being abusive and not taking a salary. Wow, this is a sweet deal. I've got an S corporation. I'm not going to pay myself a salary. I'm just going to take all the money out in distributions. That's a violation of IRS code and federal law. The courts have blown this up multiple times. So now you've got taxes on your net profit of $25,000 at a 25% bracket. You've just shaved $15,000 off your tax bill. Yay, you're going, but that's a red flag. You will end up on the IRS's radar with that. C corporation, this is where that double taxation comes into play. You're taking a salary, you're taking dividends, and you end up with about the same that you're paying as a sole proprietorship or a partnership, about $40,000, because the corporation is going to pay $12,000 tax on the net profit before you even take it out as a distribution. So S corporations, real quickly, a little bit of history. They were established back in 1958. So the concept of the S corporation has been around for a while when Congress added sections 1361 through 1379 for our tax geeks that want to do some reading. What S corporations did was they blended the benefits of C corporations and the pass-through income feature of partnerships, allowing the owners to avoid self-employment and payroll taxes on the pass-through portion. So this was a screamingly beautiful benefit, especially at a time when corporate tax rates for C corporations were topping out around 40 to 45%. So now we've got a situation where we can take a payroll, and then the pass-through income can come through not subject to payroll taxes, and then also possibly at a lower individual rate than paying the double tax of the 40% corporate tax, 25% personal tax. We've got 65% tax just taking that money out of a C corporation. So to make an election, you would file a 2553. This is the form that has to go into the IRS to establish a business entity as an S corporation. There's an effective date that you put in here. It has to be signed and acknowledged by all members or shareholders of the entity. And then IRS will send you an acknowledgement of this. It's your responsibility, or whoever your lawyer that's helping you set this up, to follow up with the IRS if you don't have that acknowledgement letter within 60 days. There's a special number you call to follow up on that. If you don't get the acknowledgement letter, you don't have any documentation that your S election has been accepted by the IRS. And that's very important to have that letter, very important to keep it in your records to make sure that it's part of your permanent corporate file. And what that letter looks like is this. It's a 3-page letter, and most people ignore the second page because it's on the backside of page 1. In nice big bold letters there on page 1, you will be treated as an S corporation starting on whatever the reasonable election date that you requested was, as long as IRS doesn't shoot it down. But really the important part there is on page 2. And this is where you can get tripped up. Payments to shareholder employee for services rendered. You must determine a reasonable salary. It's right there on your S Corp election acknowledgement. You must determine a reasonable salary when a shareholder employee of an S corporation provides services to that S corporation. Those payments to a shareholder for services are wages and are subject to employment taxes. There's no maybe subject to employment taxes. There's no you can take them out without taking a salary. And then the IRS notes there that they have the right to recharacterize distributions that you take as a shareholder if your distribution was paid in lieu of reasonable compensation. So they can go back and reclassify that salary, those distributions as salary, and charge back taxes and penalties on that. So here's how the S corporation works. As we talked about, we can split your profits and your income from the S corporation between salary, reasonable compensation, and income. But how do we establish reasonable compensation? I've got some choices here. If some of you are interested and would like to play along with this, we'll take about 15 seconds or 30 seconds here. So which of these methods are recognized by the IRS for establishing reasonable salary for an S corporation owner. Can we use the industry rule where we set wages as a percentage of sales or revenues based on industry standards? I don't know. Can we use a 50-50 rule where, like on the graph there, we've got 50% distribution, 50% wages, or other similar percentages that you may hear about? Well, let's use a 60-40 split or a 40-60 split. Or can we use the safe harbor rule where, as long as we set our wages at the Social Security max cap, which is $147,000, IRS is going to care because all the Social Security taxes that I'd be subject to would be paid by that. Or would it be all of the above? Or would it be none of the above? This is a great test and a great quiz. And I appreciate RC Reports for doing this survey with people, because it really opens your eyes to the information that's out there. And let's see, I've got a couple answers coming through. I appreciate that. Excellent. Okay. All right. Got some people looking at A for the industry rule as a percentage of sales or revenues. Okay. All right. Of course, I'm going to have to burst some bubbles here. The correct answer on this is none of the above. And RC Reports, the service we use, surveyed 10,000 tax advisors so far this year in 2022. And 75% of those 10,000 tax advisors believe in either A, B, C, or D are reasonable methods that IRS will accept for establishing reasonable compensation for an S corporation owner. Unfortunately, they won't accept any of those. So digging further into how this split works, we split the proceeds again of your S corporation into salary and income. And on your salary, you're going to pay FICA and Medicare taxes, both the employer and employee portion, up to 15.3%. And then on the other side, where we're taking just distributions, pass-through income, there is no FICA or self-employment tax on that income. That's the real sweet benefit of S corporations. That's what makes them really attractive for business owners that are generating some good profits that they want to take and pay as little tax as possible. But here's the red flag, and this is what we're going to dig into next. Red flag is when there's little or no salary. Remember that letter, that acknowledgement letter? It says you have to take a reasonable compensation. W-2 wages, subject to payroll taxes. So what is reasonable compensation and how do we fix this? So here are some of the factors that the courts have determined, have used in determining reasonable compensation. The nature of the business. Now, professional services firms are more dependent on the owner's personal effort. So there's probably a chance that they're going to require a higher reasonable compensation for, say, a physician, an accountant, an architect, an engineer, than they would for somebody that owns a business that's capital intensive, that has a lot of equipment, a manufacturing company, somebody that has to have trucks on the road, things like that. They're going to look at the employee's qualifications, the owner's qualifications, responsibilities, and the time they devote to that business. They're also going to take a look at compensation compared with non-shareholder employees, or look at previous years. So if you've got somebody that's doing an equivalent or similar job to you in your S corporation, and you're paying them 3 times what you're taking as a salary, the courts are going to question that. And then what are some amounts comparable businesses are paying for comparable services? We call this a market approach. And then sometimes they will look at compensation as a percentage of corporate sales and total distributions, but they're going to blend it all. They're not just going to use a percentage of sales revenue and not just a percentage of net profit. They're looking at all of these factors combined to determine whether or not the IRS has a reasonable challenge. And how are they going to know about this? Well, IRS has multiple paths that can trigger a reasonable compensation audit. Here's the first one that just is glaringly obvious. If you file an S corporation return, your compensation of officers is reported on line 7. That's where you report the wages or reasonable compensation. And that should tie out to your W-2 that you receive from that business. On page 5, on line 7 of Schedule M2, this is where you calculate out the equity section and accumulated earnings. And line 7 there has distributions. So if there's a large disparity between those and it doesn't look reasonable, That's avenue number one for the IRS to look at this and run some analysis and say, something's wonky here. We don't have any number on line 7, and we've got $500,000 in distributions on the M2 schedule. There's also a form 1125E that goes with your S corporation return if your receipts are 500,000 or more. So if your gross sales are over $500,000, this also lines out compensation in detail on this schedule, shareholder employee by shareholder employee, including how much ownership they have in the business, the percentage of time they provide to the business, and what their compensation is from the business. So this is avenue number one that is really an obvious thing that IRS would look at. Now, some of the other things, some of the other paths that IRS has that can trigger a reasonable compensation audit, we've got standard audits, examinations. If you're selected for an audit, either on your business return or the shareholder's return, IRS is required to look at compensation on that return and determine a reasonable compensation factor, if it complies or not. IRS also has a compliance initiative project, and in August of 2020, they began the newest CIP targeting non-payment and underpayment of compensation to S corporation owners. So they've got a new project that's specifically built for targeting this underpayment. Then they also have worker classification audits that can be used. And if you're avoiding payroll taxes by paying employees as contractors, you may be opened up to a worker classification audit. Now, in some cases, that's appropriate, and you may win on a worker classification audit. There's a case for a nail salon in Florida, and in nail salons and other health and beauty establishments, there are two ways that workers get compensated. Sometimes they're paid as employees, W-2 employees, and they get tips that are included on their W-2. Sometimes maybe the owner provides them with a booth or a workstation, and they pay booth rent, is what it's called in the salon industry. And they are 1099 contractors. They pay the owner rent for using that booth, and they go out, they find their clients, or they get walk-in clients from the reputation of the shop, and they are responsible for their own income, their own profit, their own loss. If you pass that workers' classification audit, you're not in the clear. IRS agents are now mandated, when they do a worker classification audit, to go back and review the compensation of the owner as well. Now, if you've got an S corporation and you've got a lot of 1099 contractors working for you, if they do a worker classification audit on your 1099 contractors, they will be looking at your reasonable compensation on your 1120 as an owner. So that's going to be part of that worker classification audit. Now, why do you care? So being on the losing side of an audit or a court decision can be really expensive, not just from the term of the legal fees that you have involved, but also what happens when those distributions get reclassified. Now, we've got a very famous case, and I alluded to this in some of the emails I sent, Watson versus Commissioner. This was from the 8th Circuit in 2012. David Watson paid himself $24,000 salary annually in 2002 and 2003. So $24,000 a year for 2 years. At the same time, he took almost $380,000 in S corporation distributions. He did not have reasonable basis for his salary. He had no documentation. He, for lack of a better term, he swagged it. The court decided his compensation should have been $93,000 for those 2 years, not $24,000. Watson and his company, because this is payroll tax issue, were held liable for over $48,000 in payroll taxes, penalties, and interest. The payroll taxes alone were only about $20,000 of that amount. We use a factor of 2.5 that usually works out to calculate what the total penalties, interest, and taxes will be. Once you determine what the shortfall on taxes are, you can figure on paying about 2.5 times that amount to make up the penalties and interest that accrue. Now, here's the thing that the courts looked at. Mr. Watson held a graduate degree in his profession. He had 20 years of experience in his profession, and he worked full-time, 35 to 45 hours a week in his profession. That definitely sounds like it's probably not going to be justifiable for a $24,000 salary annually. Now, Mr. Watson was also professionally licensed in his profession. He was a certified public accountant. Now, if anybody should understand reasonable compensation, it should be a CPA probably. But in either case, neither you nor Mr. Watson want the IRS or the courts deciding what your reasonable compensation should be. And the first one to the table with a fact-based figure wins. In this case, Mr. Watson had no justification for his $24,000 salary. If he had had some analysis and some reports and some documentation, he might have stood a better chance. I doubt that he would have been able to justify $24,000, but he might have been able to justify something less than the 93 that the court came up with. And we have another example here. This is Sean McAllery versus the commissioner. They were in court against the IRS in 2013. His company was a real estate company. In 2006, the net income from the business was $231,000. He took distributions of $240,000. That's another situation that we probably need to look at a little bit later. His distributions were more than his net income. His salary was zero. His primary role was a real estate broker. So as happens typically in the real estate profession, he worked full-time. He worked about 12 hours a day, 6 to 7 days a week. That is definitely full-time. IRS compared his performance to peers in the industry and calculated what his compensation should have been was about $100,000. Now McAllery came back with a calculation of $24,000 based on some notes that he put in the corporate records a couple of years prior. But there was no justification. There was no documentation. There was also no documentation really from the IRS. They used peer comparison in the industry rather than anything documentable as far as reasonable compensation. So the court disagreed with both, actually. McAllery didn't have substantiation of an arm's length agreement negotiation basis for his salary. He had no documentation establishing what factors came into that salary. And the IRS could explain how a percentage of gross receipts or pure industry comparison could aid the court in determining this. So the court calculated his salary as $83,000. Now that's still 3.5 times what McAllery said his compensation was supposed to be. Using that 2.5 factor estimate, rough estimate of taxes, penalties, and interest, just for 1 year would be in the range of about $32,000. So again, not inexpensive, and the representation that he probably had, unless he was doing pro se, representing himself, is also not expensive, but your time is worth something. And the time you have to take representing yourself takes away from other things that you want to do. So continuing on with the why do I care, taking no salary like he did, and thus not filing the required payroll tax forms means first, back payroll taxes due. Failure to file the required forms penalties, fail to pay the taxes penalties, and fail to file required information returns, which are forms W-2. Those penalties can get up to $1,000 per form that is not filed. And here's the scary part. There's no tolling of the statute of limitations. Typically, the IRS has about 3 years to audit from the date a return is filed. In some cases, they have up to 6 years. If no return is filed, that tolling date, that statute of limitations never starts to run. It remains open. IRS technically has forever to audit and impose taxes. No expiration of the assessment statute for 3 or 6 years. So they've got about 3 to 6 years to audit and assess taxes, and no expiration of the collection statute, which is 10 years. They can go back forever. Do they? Most cases not. Most cases are going to go for 7 years, but there's no guarantee. If you don't file a return, there is no tolling of that statute date. There is no expiration. So keep that in mind as you're going through various analysis of your S corporation compensation. Now, here's a couple of things here that are historical in perspective and why IRS has been directed to look at this. In 2009, the Government Accountability Office calculated that for 2 years, 2003 and 2004, net shareholder compensation underreporting equaled about $23.6 billion. So that's a substantial tax revenue source for the federal government that's being overlooked, that isn't being collected. So IRS is going to go through and start collecting these. Also in June of 2012, the Treasury Inspector General for Tax Administration, TIGTA, recommended adjustments from S corporation audits are substantial at that time, but the number of no change audits was a concern. They were recommending an additional 5.7 billion in adjustments, just from a review of what the IRS audits were coming up with. Now, here's the most recent thing that it kind of makes it a little bit scary. In August, just a couple months ago, U.S. Treasury Secretary Janet Yellen sent a letter to IRS Commissioner supporting the $80 billion in the new budget allocation for the IRS. Now, I've debunked some of this, but there's still a very big concern here. IRS is going to be able to hire, with that kind of budget, about 87,000 new full-time equivalents. Are all of them going to be auditors, revenue agents? Maybe not. But a good number of them will, and a good amount of that 80 billion in budget is going to go to compliance. But she also reaffirmed the administration's commitment to not increase audit rates on Americans making under 400,000 a year. Do you see the corollary directive to the commissioner in that statement? We're not going to increase audits on people and taxpayers making under 400,000. But that doesn't mean we're not going to increase them on taxpayers making more than 400,000. There's a hidden corollary directive there that as enforcement increases, they're going to go after the low-hanging fruit that's going to give the government the highest revenue source. Now, a couple of things that have happened in recent years. In 2018, the Austin, Texas IRS field office graduated 2,500 field agents that were specifically trained in reasonable compensation. So they now have 2,500 agents out there that are doing audits that are specifically trained in reasonable compensation audits. Also, that same year, they changed their audit checklist for just general audits. And every single examination, every single audit of a closely held S corporation has to include a reasonable compensation audit. And then as part of the tax changes back in 2017, this is a big change. If the IRS issues a notice of employment determination in a worker classification audit, the taxpayer cannot take that, if it includes a reasonable compensation component, they cannot take that case to the tax court. They must pay the tax and they must sue the government for a refund. So this has changed the playing field in worker classification audits where reasonable compensation target is in there as well. So unfortunately, S corporation compensation audits are going to be low-hanging fruit for the IRS. Now we've got some other considerations here, and I'll run through these fairly quickly. We've got some other workshops that we'll have coming up for these. The first one is something you have to realize when you've got any kind of pass-through entity. Your tax is calculated on your pass-through income, not on the distributions you take out. So this hurts highly leveraged companies that have a lot of debt, and they have to use up that cash in the business from operations to pay loans and credit cards, leaving little or no cash for distributions. And some of those distributions are used to pay the tax liability. So the taxes are still calculated on the net profit. But if you don't have cash flow in your control, you could potentially end up with a cash shortfall and a tax liability and have to kind of play catch up on that. The other thing is qualified business income deduction. That's that new credit that could potentially exempt up to 20% of the company's pass-through entity income from federal income tax on the personal tax return. Now, this is important in how you balance out that salary versus pass-through income. Again, this is an incentive to lower your personal salary to increase the pass-through income and increase that KBI deduction. But if you get caught up in a red flag audit for compensation, this can twist that and reduce that, increasing your taxes further. And then something new that's on the playing field, and we are going to do a workshop on this, is the pass-through entity tax credits. If you recall, when Tax Cuts and Jobs Act came through in 2017, of course, Congress always says, we're not going to raise taxes, but we are going to limit your deductions. Well, they put a deductible cap on deductible taxes on your Schedule A, if you itemize, of $10,000. So anything over that amount is no longer deductible, and there's no carryover provision. So you don't get to carry that forward to future years. It's just lost. It's a lost deduction. This really hurt taxpayers in high state income tax states like Texas, California, New Jersey. And I'm sorry, Texas doesn't have high income tax. They have high property taxes. New Jersey, New York, where a lot of people were itemizing and paying substantially more than $10,000, but now they're capped out at $10,000. That has been looked at a workaround opportunity for quite a while. And now the states are coming out with what's called a PTET, or pass-through entity tax credit, where your pass-through entity can pay the tax for a portion of the liability on the pass-through income on behalf of the shareholder or partner. And that comes through as a credit on the K-1. It's a deduction for the entity. It's a tax credit for state taxes for the partner on the K-1 for the state taxes. And that avoids having to carry that through as a personal expense on Schedule A. So you no longer lose out on the deduction, but you get a credit for the tax paid on that. We will have a workshop coming up on that. It's interesting that just in the span of about a year, 31 states have jumped on this bandwagon and either have enacted or considering enacting regulations for PTET. The crazy part is every state has different rules. So we've got to factor that in as well if you're operating in multiple states. The last thing I want to touch on the other considerations is phantom income. I alluded to this a little bit in the McAllery case, where he had a certain amount of net income, but took distributions over that. If you take distributions in excess of your basis in the company, in the S corporation, that's a taxable return of capital. It's going to be reflected as distributions in excess of basis on your Schedule D, on your personal return. And that's taxed on the amount that you took over your accumulated net profit. If you take distributions out beyond that, what happens a lot of times there is you may have a line of credit, you may have a loan that provides cash in the business, but that's supposed to be used for operations. If you use that to take as a distribution and you don't have the net profit to back up that withdrawal as a distribution, you're going to be taxed on that phantom income. You're going to be paying capital gains on that. And then that capital gains tax is going to continue if you continue to take distributions until you've made up that missing basis. So this is something to be very, very cognizant of as you take distributions out of your S corporation. So let's get to the fun part here. What is the solution, right? That's what you're all here for. You want to know the solution. We've outlined the problem. We've outlined the potential red flags. We've outlined that IRS is going to be increasing the review and audit of S corporation owner compensation. How do we fix this? Well, we first have to go back to that definition of reasonable compensation that the IRS has in the Internal Revenue Code. And again, if we've got tax geeks here that want to look this up, section 162-7B, paragraph 3, it is in general, and in the bold part there, reasonable compensation is ordinarily be paid for like services by like enterprises under like circumstances. So if you're underpaying yourself compared to what industry is paying for reasonable compensation, you're a red flag right there. Section 162A1 allows companies to deduct that reasonable compensation as a business expense. Wages are a business expense. Now, of course, with an S corporation, you're deducting it out of the S corporation, but you're reporting it as W-2 income on your personal return. But you have to take that reasonable compensation. Going back to the phantom income of distributions, reasonable compensation does not create phantom income like that. Distributions in excess of basis will. Now, we know from earlier when we did our little polling survey that we can't use the industry rule. We can't use the 50-50 arbitrary 60-40 percentage splits. And we can't use that safe harbor rule of maxing out Social Security wages and then leaving the rest to distributions. We have to be able to justify a reasonable salary. And what about paying the shareholders a 1099 contractor? The IRS takes this very seriously. This is from an article from RC Reports just this last January. IRS takes this seriously. The IRS will reclassify all 1099 miscellaneous payments, actually 1099 NEC payments now, made to S corporation owners as W-2 wages. Now, sometimes that means that there's several months and sometimes even years of payroll taxes that S corporation may have to pay, including back taxes for the payroll taxes, interest on the payroll taxes. If the shareholder employee was the only employee of the corporation, failure to file Forms 941 penalties, failure to pay the taxes to the IRS for withholding and employer portion, failure to file the W-2, and then back taxes for the state and local, because the IRS will share the results of a compensation audit with the state. And now the state is going to look for those payroll taxes payroll filings, interest, and penalties. So this can really rack up if it's not handled properly. Now, let's take a look at this in the solution. What is similar pay for similar work? Remember, we want to be paid for like services by like enterprises under like circumstances. You can use tools like Robert Half's annual industry pay reports that they publish every year. You can use the website payscale.com, which provides a pretty good synopsis of compensation sometimes. And you can survey Indeed.com, LinkedIn, job boards, or other job sites and find out what other people in your profession, in your role, are getting paid. But that's a lot of work, and it still doesn't give the full picture. If you're anything like me and other business owners I know, you don't only provide one service to your business. Most owners of closely held businesses are likely performing multiple job functions. You might be the chief executive. You might be the accountant. You might be the payroll clerk. You might have to take care of payroll, especially if you're the only employee. You're probably running your own payroll. You might be the sales manager. You might be out there making sales calls, putting proposals together, getting orders in, maybe even going back to the accountant, you may be invoicing for those projects. You might be the janitor. Sometimes somebody's got to clean the office, and if it's you, you might be the janitor. You might be the advertising and marketing manager, putting together your campaigns, your advertising materials, working on getting the printed collateral, getting your brochures. So you need the full picture. If you go out and use one of the other website options, that may not give you that full picture. So sources like Robert Half, LinkedIn, Indeed, PayScale, they only provide an estimate of what a similar employee in a W-2 position would be paid for a narrow job function. It's a rough estimate of what we call the market approach. So what are people getting paid in the market for that job? Now you can go back to those same sources and kind of split your time out and say, okay, well, what is an accounting executive or an account executive getting paid for going out in the sales field? And I'm spending X amount of time. But either way, you need that full picture to make a reasonable compensation analysis. So the first one to the table with a fact-based figure wins. So you need an actual analysis, a report, document evidencing what your compensation should be in order to have a chance of prevailing at an IRS compensation audit. We offer a compensation analysis service that provides fact-based methodology to determine that reasonable compensation. We center that analysis on geo-specific, so in your area, function-specific and experience-specific factors, and that's important to have. What you may get paid for a job in New York may not be the same that you get paid in Asheville. We use regularly updated research databases for compensation rates nationwide to build this compensation analysis. So you're not working with outdated data. You may find a job on Indeed that's 5 years old, and that's not necessarily going to be an updated research tool. And our compensation analysis gives you a documented, fact-based report, including a corporate minutes page that documents your compensation that can become part, or actually should become, a part of your corporate records. So this is a way to lock in as much as possible and audit-proof as much as possible your compensation. Can it be challenged? Yes, anything can be challenged. Can you prevail? You've got a better chance if you've got documented evidence. Sometimes it doesn't fly 100%, but you've at least got a factor that the courts will consider, rather than saying, I thought it should be $24,000, but I don't have anything to back that up. We use one of three methodologies when we do these compensation analysis projects. We either use a cost approach, which is the many hats approach that I alluded to a little while ago. Chances are, if you've got a small business, you are chief cook and bottle washer. You're doing everything and anything. And you may have an admin assistant that takes care of some of the stuff, but on all the higher end stuff, you're everything from the CEO to the sales executive. We use an income approach, which could assist sellers with discretionary income calculations and ROI valuation analysis. This is a way to determine what a reasonable return on investment would be for somebody who's considering possibly acquiring your business. And we have a market approach that supports C-level and general manager level positions, where the cost approach may not be appropriate, because in that case at C-level, if you do have a larger company and that's primarily what you're doing, we probably don't need to have a compensation analysis that includes administrative work or payroll clerk. you're a C-level executive, you're a general manager, we should cover that appropriately. Again, fact-based, because that's what the courts and the IRS will look at to document reasonable compensation. Now, what the process is for our compensation analysis is we provide you with an online interview link that queries you on all the various services you may provide for your business and your skill level at that job function and how much time you spend on that role. So it goes into detail, not just what you're doing, but how much of your time is devoted to that, how adept and experienced you are at that particular function. Some things you may be an expert, some things you may be average capability at. Once your interview is complete, we prepare a draft compensation report and we'll schedule a Zoom call, a 30-minute Zoom session to confirm the information in the report, review it with you, and then discuss any updates or modifications that you may want to report before adjust before finalizing the report. You'll be able to make updates to that same interview link. And then once complete, we'll prepare your final compensation analysis report and the supporting documentation for that current year. Now, I'd recommend that the compensation analysis be done every year. Payrolls change, but really, if you want it as up to date as possible, you should probably do it annually, no less than every other year. But it's important to have a documented analysis to justify your compensation. Now, our family office service clients, and we've got several on the call today, you receive an annual compensation analysis as part of your family services at the select and elite service levels. I've never offered this service as a standalone service. It's always been part of our client service programs. So this is a one-time thing that I'm considering here. Treasury Secretary Yellen's letter to Commissioner Rettig and the increased scrutiny and the IRS automation processes that are going into play here. They got red flag target written all over them. So I am offering this one time as a standalone service if you're interested. So option one-time standalone offer if you're not in our family office services programs. I want to help you get that target off your back. You're going to get our complete analysis service if you opt in and engage us for the services by next Friday, November 4th. You'll receive that full interview, the review meeting, and the final report for a one-time fee of $997. To take advantage of this offer, you just shoot me an email at info@fortaxcpr.com with one time in the subject, and we'll get you set up, get all the links to you, and we'll start that process and get that red flag target off your back. Option number 2 is tax planning season. There's no doubt about that. And the worst time to plan for taxes is April 15th. If you're not planning now, there's a good chance you'll be blindsided next spring. So option number 2, if you'd like to schedule a no obligation discovery call by next Friday, appointments will be available after that date. We just want you to make a commitment to making an appointment by then. If it turns out that after this discovery call, you're a candidate for our tax blueprint and our taxes first and math analysis services, we'll include with your initial tax blueprint a complimentary compensation analysis. Now, our tax blueprint service is the tax strategy methodology we use. And we typically find 5 figures of overpaid taxes for a lot of clients that they're just wasting money on paying too much in taxes. By restructuring some things, by looking at where they're spending money, we can look at some of the inefficiencies from a tax perspective. Our taxes first then math analysis, because we're a family office and we offer fully integrated and holistic services. Taxes first then math takes a look at your portfolios, your investment accounts, your retirement accounts, and looks for similar inefficiencies there where you may be paying too much in hidden fees, may have tax erosion within your portfolio, and maybe losing money over the course of your planned retirement accumulation that could translate to 6 figures that you don't have available as part of your retirement portfolio. If you're interested in this, shoot me an email at info@fortaxcpr with discovery in the subject, and we'll get you lined up with a discovery session, and we can see if this is a good benefit for you. If it turns out that you're not a candidate for these programs, we'll go ahead and honor that $997 in option 1 if you're interested in that. Otherwise, we'll move forward. We'll save you 5 figures, possibly, if we can, and get you on a solid footing for that habit number 2, begin with the end in mind. And option number 3 is for any of our monthly clients that aren't on the family office select or elite plans. Go ahead and let us know if you'd like to upgrade to those levels by next Friday. just shoot us an email at info@fortaxcpr.com with upgrade, and we'll get that upgrade option over to you and get the compensation analysis started for you. This is one of my favorite slides that I like to have in presentations, but as we know, we've got an instant gratification society mentality here, and sometimes that can shoot us in the foot. Veruca Salt learned this in Willy Wonka. I want it now. And setting up your entity properly is important. Setting up your compensation plan is important. That's why I keep quoting Stephen Covey's habit number 2. You want to make sure that even though you want it now, that you lay the groundwork in the roadmap to make sure that you're still in good position 4, 5, 6 years from now, when you're hopefully making more money, hopefully setting yourself up for retirement and legacy, maybe even setting up a good compensation legacy for your kids, your grandkids, supporting your family, giving to charity, all of those things that business can do by creating more jobs, creating more opportunity, creating more benefits for society. We want it now, but we need to plan for what the future holds. And as Zig Ziglar says, you can't hit a target you cannot see, but you cannot even see a target you don't have. So it's important to set up that target. I want to thank you for your time today. We're actually a little bit over today, but I'll open it up to any questions you have. Again, this has been recorded. I will make the recording available to you. But if any questions are coming through on the Q&A box, I'll go ahead and see if I can answer those. Okay, Chris, yeah, let me follow up with you on that. The answer is yes, but we typically fire warning shots across the bow. But I'll get back to you on that kind of directly offline. Okay. Not seeing any other questions coming through. All right. Well, if you do have other questions afterwards, it may take a little while for this to gel in your brain. I do tend to throw a lot of information out there, and Laura tries to dial me back sometimes. But what we do is we try to give information that's usable. We try to break down tax code into plain English as much as possible. Okay. Oh, we do have. We've got a question from a person here. I am mostly a 1099 employee, but some employers pay me as W-2, which is right. There are bright line, well, used to be bright line tests for that. The correct answer is, unfortunately, it depends. 1099 is a 1099 pay. You are not an employee, you're a contractor. So you're responsible for all taxes. You're responsible for anything that comes through in that regard. If you have people that are paying you for the same job function as a 1099 contractor and as a W-2 employee, chances are there's a worker classification issue there. If you're in business, then you really shouldn't be paid as a W-2 employee unless that's mandatory with the company you're working with. In that case, you can't include that in your business income, and you can't write off deductions against it. But with the 1099, we'd probably have to take a look at that and see, are these similar functions, or do we have different operations? Now, that's not to say that if you have a regular job in a certain industry, as long as you're not subject to a non-solicit, non-compete, you could do a side hustle in that essentially same function possibly, and run that as a business as well. Now that would be a clear delineation between working for a corporation as a W-2 employee and having a side hustle where you're paid 1099 or invoice clients and get that revenue separate for your own sideline business. Okay. Great. And looks like everything else is quiet. So thank you again for your time today. I know that we all have busy schedules. I appreciate you joining us today. If you do have any questions after the fact, feel free to shoot us a message or an email, and we'll talk to you soon. Have a great rest of your day. Thank you very much, everyone. Bye-bye.